Hey guys, welcome to the Day Worker Night Trader channel. I'm here to share with you the ways to make money if you can spend 1 hour a day on the stock market. Today's video, I'm going to talk to you about cash secure put. If you're considering to buy any stocks right now, please stop and watch this video first. You may be able to find a much better way to get the stock you love in a much safer way at a discounted price. I will also share with you the actual trades that I have done that made $2,400 in the last video and the existing open positions that I have, so that in about 1 to 2 weeks we can come back to see if I have made or lost money with the strategy. This video is part 2 of the previous one here. Please go check that out. I also highly encourage you to watch this video as it helps identify the right kind of trading or investing strategy that fit your risk tolerance and commitment to trading.
You do the best and are the most happy when you do what suits you as a person.
If you are new to the channel, please tap to like and subscribe. If you don't have a broker account or are looking to switch to another broker, I highly recommend Interactive Broker. The commissions is very low, with low margin interest, and give you access to lots of product, stocks, bond, ETF, options, and the best part, you get 1% of your deposit worth of Interactive Broker stocks for up to $1,000. I think this deal is good, almost as good as my sense of humor and my editing skill. Without any further ado, let's make some money.
I got broads in Atlanta, just to me in the family, credit cards and the scammers, getting the licks in the band.
Hey guys, welcome to the part 2 of the options trading lesson. If the last time we have talked about what is a call option, what's a put option, we are going to talk about cash secure put. Before I go to the video, just some excitement for everyone. Let me just show you upfront the results when I use cash secure put strategies, and later on I'm going to explain a bit more on how to structure this trade. But from cash secure put strategies, I was able to make $2,400 in the week of 15th of March. And later on, I'm also going to show the existing positions I have right now, so that in the next 1 to 2 weeks, we can come back and review to see whether I have made money or I have lost money based on this strategy. In the next 10 minutes, I'm going to go through 3 things. Number 1, just a recap of options basics and covered call. For more details, please go to this video. I actually made a much more detailed explanations there, together with the specific examples, and I also leave a screenshot of my covered call selling on the week of 15th of March for you to take a look. And the second thing, I'm going to talk about cash secure put and the benefits of selling cash secure puts, especially in an extremely volatile environment that we are in right now, where there's a lot of bull traps in the market and you don't know if after a short bull run, the stock is going to dip right next week. Thirdly, I'm going to briefly touch on the 3 applications of cash secure puts, namely to buy stock at a discounted price, to buy the dip with some safety, and lastly, selling puts for passive income. Now let's just go back and do some recap. In the last week lessons, I actually talked about covered call. So just to recap, when you buy a call, you specific a strike price and the expiry date, you pay a premium, and then at that date, you get to buy the stock at the strike price if you choose to. If you sell the call, you earn a premium, but you have to sell the stock if the strike price is less than the current stock price. So essentially, the covered call strategy is when you sell a call and have enough stocks in your account to be ready to sell the stock at the strike price that you love while collecting weekly income every single week. So this is kind of like a win-win strategy for you. If the stock doesn't go to the strike price, great, you keep the premium. If the stock go exceptionally high and hit the strike price, you're more than happy to cash out, and then you are going to use this week's strategy, cash secure put, in order to get back your stock at a discounted price to repeat the whole cycle. Now, for put, when you buy a put, you pay a premium in order to sell the stock at the strike price. But when you sell the put, you earn a premium, but you have to buy the stock if the strike price is less than the current price. Therefore, cash secure put strategy is when you sell the put and reserve enough cash and buying power in your account to be ready to get assigned the stock at the strike price that you love. But at the same time, people are paying you for waiting for you to get the stock at the price that you love. That's why this is a very beautiful strategy. Even though you may not be able to make as much money as covered call, but this strategy is much safer, and this strategy is also much more suitable for the time when the market is generally going down right now. Now let me share with you one specific example of the applications of cash secure put. So in general, you're going to use cash secure puts if you want to get into a stock at a certain price, but you are not sure if the stock is going to continue to dip, and hence you don't want to commit your capital right now to just buy hundreds of these stocks. The stock that I'm going to use today, for example, is going to be Apple, because Apple is a big company. It's a very safe stock for you to own and keep in your portfolio for the long run. The stock has grown tremendously in the past 5 years, but recently has been taking a dip. So we can see over here, in the past several weeks, the stock has dropped from a high of $145. Now the stock is trading at about $120. I think the exact price point is $121. So the stock has dipped 17%, and you feel that this is a good price for you to get in. However, quite a number of things that you're uncertain about. Number one, in the past few weeks, you know that the market is selling off, and there's a rotation from tech stock, from growth stock to safer stock. So at this point, you wanted to own the stock, but you were not sure if $121 is something that you want. Second thing, when you're taking a look at the technical charts of Apple, you realize that in the past 3 to 4 weeks, there's a very strong support at 108. So in the day where there's a huge volatility in the market, but prices tend to bounce back when it goes to 118. There's only one single red day where the stock actually dipped down to below 118. So we can see that 118 is quite a strong support that we have seen so far on Apple. So you would love to get in Apple stock at the price of 118, because compared to the prices today of 121, that represents about 2.5% more of potential upside if you can get in at 118 and then the stock bounce back to the level today and beyond. So let's assume that the pricing of 118 is the price that you really want to own the stock. There's a few things that you can do. Number one, you can place a limit market order at $118. Or number two, you can sell a put at the strike price of $118 for a premium of 56 cents. So when you sell a put, what it means is that you are signing a contract to buy the stock at $118 if stock price go below $118. But to take on this contract, you have paid 56 cents, therefore you get $56 from this. Additionally, if you are desperate for the stock, you can also sell a put at $119 for a premium of 77 cents. First of all, what is the return on your capital if no stock is assigned? So now the stock is trading at about $121, but the market condition is actually getting better, and there's a strong support at 118, so stock price didn't go back to 118 at all. Well, in the first case scenario, because your order didn't get filled, so your money is sitting there doing nothing, you don't get any stock, you don't get anything, right? So the return is actually 0%. In the second scenario, if the stock didn't go down to 118 at the end of the week, you didn't get the stock, but at the same time, you get 56 cents per stock, which represent 0.5% a week in terms of return, which is about 30% annualized. 30% annualized is good. In the second scenario, if the stock didn't get filled, you get 56 cents per stock, which represent about 0.5% return a week or 30% annualized. A typical stock returns for the whole market is about 6 to 8% per year, so 30% annualized is a very good return, especially this is the premium that people are paying you in order for you to take the worst case scenario to get Apple stock at the price that you want. Now for the third scenario, so let's assume that you didn't get the stock, and so the stock didn't even go down to 119. You're getting 77 cents, which is 0.65% a week, which is 38% annualized. So in this case scenario, you get more money in terms of the premium, but the trade-off here is that you're more likely to get assigned the stocks because you pick a higher strike price for your put. But the good thing here is that you love Apple stock at 121, so in the worst case scenario, if you get stock at 119, you would have loved it. So this is also a trade-off for you. If you want higher likelihood of getting the stock, but at the same time being paid a better premium, you can pick the strike price just slightly above your support. Now the second scenario, now we actually come to the part where hey, you get the stock at. Now come to the second part. If the stock is assigned, what is the effective price? If you place a market order, the stock price 118, which is the price that you pay. If your put order at 118 at 56 cents is being filled, your effective stock price actually 117.44, because for every single stock that you got at 118, you have 56 cents in terms of premium. So you actually get the stock at a lower price. Now the next scenario, if you sell put at 119, the effective stock price is actually 118.23. If you just compare these two scenarios between doing a stock buy order at 118 and selling a put at 119, right? If you sell a put for 119 every single week, someone is paying you a premium that is equivalent to 38% annualized, and you get the stock at just 23 cents more than how much you would have gotten the stock if you get the stock at 118. Now, let's come to the next point of why I love cash secure put. In the event that Apple crashes, if your orders at 118 is getting filled, you're going down with Apple stocks, right? But however, if you're having a put at 118 or 119, depending on the timing and the extent of the crash, you can roll out the option to next week. So what's the meaning of rolling out the option? Let me explain to you. Coming back to the example, today's Monday and the stock is trading at $121, for example. You wanted to get the stock at 118, you sell put at 118 and collect the premium. All nice and beautiful. Now coming Friday, stock price come down to $117.50. So now if you do nothing and just wait until Friday is over, you're going to get assigned 100 stocks at the price of 118, but the effective price is $117.44. So you're still making some money, right? And you're getting a stock at a slightly lower price. So all is good. But now what's happening is that you're talking to some friends, you go online and check the news, you see that hey, market recovery is coming, there's more stimulus in the market, there's a new Apple phone is being announced, there's some new ventures of Apple's doing some cool things like iRocket, like some cars, Apple producing sunglasses. So you feel good about owning Apple stock at this point. So all you need to do is just chill till the end of the day and take the 100 of the stocks and get ready to sell covered call next week. And to understand how to sell covered call, please check out this video over here. Let's take a look at the other scenario. Check out the news, you talk to your friends, and the census is that hey, there's a corporate tax raise that is coming, right? Or Apple is facing some lawsuits with uncertain outcomes, or suddenly, hey, Apple, right? You fear that Apple is going to be banned in China, or you're afraid that the market sell out is going to continue, or you're checking the futures is down. So what do you do at this point? You roll it out. So when you roll out an options, it means you liquidate the current positions and then place the new positions in the future. So in this case, you buy back the put at the strike price of 118. The premium now probably is 50 cents because it's very close to expiry, and then it's 50 cents below your strike price, so probably you need to pay 50 cents to buy it back. But what you're going to do is that you're going to sell another put at the strike price of, let's say, 113 or 114, 112, right? But expiring the following week, and continue to collect 50 cents, 60 cents, whatever that is. So what you're doing is that you are delaying the choice of getting the stocks into the future, at the same time getting paid for waiting for another week. Doing all this, what do? Number one, you need to find the stock that you would like to own. So once again, this has to be the stock that you love, this has to be the stock that you trust, this has to be the stock that you have done your due diligence on. Second thing, you select the strike price that you would like to get the stocks, or where you achieve your desired yield. So yields here refers to the ratio between the premium that you get over the total amount of cash that you set aside in the event that your stock got assigned. Number one, you can select the strike price where the probabilities of profiting for the buyer, remember the probability of profiting for the buyer being less than 20 to 25%. So which means that 80% of the time you either don't get assigned any stock and get the premium for free, or you're going to get assigned a stock at a discounted price. And this percentage is actually being shown in Interactive Broker. So it's another advantage of you when you sign up for Interactive Broker. In the second scenario, if you're owning a stock like Apple's, you can select a strike price where the yield is about 0.5% to 1% weekly. So just now in the example of Apple's, all the data and all the numbers are actually real. So let's say the stock price today is $121, and if you want the yield of 0.5%, the strike price is actually at 118, about 2.5% below the current stock price. So actually this is the fair discount, and the probability of getting assigned is actually fairly small. So for stock like Apple's, you can take 0.5%, and this 0.5% a week is equivalent to 30% annualized profit in premium. So it's a very good number for you to start selling cash secure put. Now the last thing is that if now there's a lot of uncertainty in the market and you're very afraid that the price is going to come down, what you do is that identify a support similar to how I identify a support at 118 in the above example, and place strike below the support. Or if you really love the stock, you want to get in and you don't mind the worst case scenario, you get the stock at a slightly higher price, you can place the strike price right above your support. And now let me show you the trades that I made on the week of 15 March. This is exactly the same that I showed in the previous video. In this week I made a total $2,400 US. So the first put is on RK. I actually identified two levels of support at 122 and 120. At the first put, I got a total of $630 in terms of premium. The stock closed at slightly lower than the strike price, so $15 is going into the red. So the total profit from here is $615. For the second put, because the ending price here is higher than the strike price, I get to pocket the entire $850 in premium. For cents, back then I identified there's a support level at $3, so I sold a put at 3, and then the stock ended up at $3.2. Hence I get to keep all the premium from selling the put at $655. Now lastly, for Mara, I identified a support back then at 37. And the stock closed at $43.24, so I get the profit $279.26. So in total, this is how the $2,400 is made in the week of 15 March with this trades. Now coming to the exciting part. So my ongoing cash secure put that I have in my account right now. Number 1, April 1st expiry. So tomorrow, right? For the April 1st, you can just take a screen cap of this and go tomorrow and see the stock price. If the stock price all close above all this level, this is the money that I have made in the week. And then yesterday, when Apple dipped in the first hour of the trading day, I actually sold the put on with a strike price of 118 and 117, right? So with only 2.5 trading days from the expiry date, but we are able to cash in $140 for the rights to get Apple stock at a very attractive price. If you have a account with sizable buying power, you can make quick bucks. So this $140 potentially, finger crossed, if Apple stay above 118, $140 for me. If Apples go down below 118, I'll be more than happy to take up the stock. I decided to just open some of the put positions expiring on April 9. So the first one, PSTH, the same strike price of $23.50. You can see here the premium here is much more than the premium here. So this premium is when I opened the position 5 days away from expiry. And here, right, if you have about 9 days away, you are going to get quite a lot more premium. Right, so I wanted to just open this position and let the long weekend do the work. The second transaction I opened is on RK. I do feel that 105 is a very strong support for RK. So by the same logic, I opened some of the trading positions for the week after with $420 in premium. Next, of course, Apple strong stocks, loved 117, so I sell to put. And lastly, CCIV, right? I mean, one of the stock that I like, same logic as above, so I sold another 8 contract for $690 here. So the same thing, on the 9th of April or on the 10th of April, you guys can just take out your phone, check the stock price, and we can see how much money that I lose or how much money that I make, right? For penny stock, you can only sell monthly option. So I do have a sizable amount of premium that are being seated with Sense and NNDM, which are the 2 penny stock that I like. So as you can see here, right, if you have a sizable trading account and if you can identify the suitable support for each of the stocks and you do due diligence on the stock that you want to own, selling cash secure put is a very good way for you to earn some good income, right? Especially now when it's a very difficult time. If you buy the stock outright, you may suffer the losses in the short term. That's it for today, guys. I hope you have had a great time learning. If you find the video helpful, please help to like and subscribe to the channel. If there's any topics that you're keen to learn more, please do let me know. Or if you have any questions on the topics of covered call, cash, secure puts, or anything else that is related to the stock market or personal finance, do let me know. In the next 3 videos, I'm going to cover number 1, some of the financial advices online that you may need to think twice about before following. Number 2, I'm Asians, right? So as Asians, we are taught to buy a house. So since very young, if I have some money, how do I decide between stock investing and buying a piece of land or buying a house? I'm going to do a pro and cons video and explaining some of the factors that may influence your choice, and I'm going to share with you my personal choice of whether I like a house more or I like stock investing at this stage. That's it for today, guys. I hope to see you next week, and until then, let's make some money.
Panda. I got broads in Atlanta, just to throw me in the family. Credit cards and the scammers, getting the licks in the band.